Welcome to everyone here today. Hendrik, Sam, and Sydney, it is a pleasure to speak with you again. It's been a pleasure working with you as we were together for one of the first evaluations we did for the Impact Evaluation Lab. And that was, of course, with your firm, Advanced Global Capital. And we're very excited to talk about that with you today, about everything about you, about us, and about our collaborative engagement together. So maybe we can start it off. Hendrik, if I could ask you to introduce yourself,
Sure.
your team, and then tell us a little bit about Advanced Global Capital, you know, everything from what you do and where you are to how you execute on your investment strategy.
Yeah. Thank you very much, Robin. Thank you for having us. My name is Hendrik. I'm the Chief Executive Officer of Advanced Global Capital, and I'm joined by Sam Miller-Hicks, who's our Chief Impact Officer, and Sydney Roper, who works in our Marketing and Impact Evaluations Department. AGC was founded about 11 years ago, or 11 or 12 years ago. And really, the mission that we set out to achieve was to provide working capital to small and medium-sized businesses around the world. I'm going to use the acronym SME a few times. So if you hear me use that, what I mean is small and medium-sized enterprises. And the focus of our fund is really to provide working capital, which means short-dated loans to these companies in emerging and underserved markets. The reason we do this, or the way that we thought about things, was that we believe that private capital can be a force for good, and it's a way to reduce inequality and a way to reduce poverty if we can generate sustained economic growth. So that was really the background or the thesis that we set out from when we launched the fund. Initially, we set the business up under the family office of Janet McKinley, which is called Money in Motion. And for about 2 years, we really trialed the concept using her personal balance sheet. And once we'd settled on what we felt was a scalable business model, we launched the fund in 2015 to external investors. Should I pause there, or do you want the conversation to flow, or do you just want me to keep on going?
Uh, Hendrik, that's a fantastic introduction.
Okay.
Perhaps you could continue to refine that. Tell us, specifically, what is the theory of change behind the work that you're doing? Lots of
Yeah.
people have an intention to allocate capital for good in a way that you've articulated broadly. But I do think that Advanced Global Capital has a specific mission that's different and differentiated, and maybe you could help us understand that.
Yeah. So it's very interesting. I mean, if you go and look at what is referred to as the missing middle today, um, there there's a missing middle number that gets quoted of $5.7 trillion. If you dive into that, what is the missing middle? The missing middle is not companies that are being financed by microfinance institutions. So it's not consumer finance, and it's not small businesses being financed by banks. These are really sort of everyone that fits in between that. And the way that it gets defined is as small businesses that are creditworthy, are viable, and should be able to attract funding, either debt or equity funding, but for whatever reason are unable to do that. So there's a huge squeeze on them when it comes to developing their businesses, to hiring more staff, and just the economic prosperity of those businesses. If you dive deeper into the statistics, what's interesting to see is that 9 out of every 10 jobs globally is a job at an SME, at a small business. Defined as having fewer than 250. Well, there's no globally a recognized definition of small business, but the definition that we use is a small business having less than 250 employees. If you go sort of deeper into that, essentially 2 out of every 3 jobs in emerging markets it is also provided by these small businesses. And what we've come to see is that these small businesses are starved of working capital. They're unable to get the capital that they initially need to survive and then to grow and thrive. And that's really the need that we are trying to fulfill. If you speak to our founder, she talks about a story of having met a woman in Ethiopia that was manufacturing shoes, and it was shoes where there was international demand for the product, but ultimately due to a lack of working capital, the business just wasn't able to scale. It wasn't able to take advantage of that opportunity set, and that's really the need that we are trying to fulfill. We are trying to come in. We are focusing on small businesses where they are typically selling to larger, more credit-worthy domestic buyers. So it could be goods or services, but they're providing those goods or services to those larger businesses. And then typically waiting to get paid sort of anywhere from 90 to 120 days. And during that period of time, the small business still needs to make payments or salary payments to staff or wage payments to temporary workforce. They might still need to hire in temporary machinery or temporary equipment to do what they do. There could be taxes payable, GST or VAT payments, and all of that liquidity pressure falls on that small business while they wait for this larger business to pay that invoice. And that's really the product that we are trying to support. We're trying to come in with a factoring product or an invoice discounting product, where we take that invoice from that small business. We will make an advance against that invoice for typically 80% of the face value. And then we take that liquidity pressure on us and we wait for those 90 or 120 days for that buyer to pay back. So that's really what we focus on.
Hmm. Hmm. So Hendrik, that is a very compelling strategy. But let me, for the sake of discussion here, push back a little. Right now, obviously, you guys have been around for a long time, so you know what you're doing. But you could say, gosh, making credit available overseas in an emerging market for the sake of a small business, man, that's a lot of credit risk. Some would say, right? How do you guys think about that? What's your response to that skepticism?
Yeah, no, I think it's a great question, and where I really cut my teeth on this type of financing was I'm from South Africa. If you haven't picked up by the accent, I trained up as a financial auditor, and I had some experience in forensic auditing, and then I joined a microfinance firm operating in 14 African countries. And the first thing that well, not the first thing, but one of the things I noticed there was the way that they were pricing their loan facilities to a consumer was exactly the same as they were pricing their loan facilities to small businesses. And the collateral requirements and the way these facilities were structured didn't differentiate between a consumer and a business. And if you analyze our loan portfolios, the small business loans had a much lower rate of default than the consumer loans. I mean, that's obvious. That's what you'd expect to see. But the way that a lot of microfinance institutions were thinking about risk didn't adjust for that and didn't take that into account.
Mhm.
So that's really where I'd like to start. Then, if you look at a white paper that we produced, it's getting on in age now. I think it's about 10 years old, but we looked at factoring and invoice discounting and domestic trade finance as a product. Um, and we researched what default rates looked like, and this was during the global financial crisis. What we noticed was default rates didn't increase by a huge number. So extension of payment days increased. The amount of time it was taking a buyer to pay a supplier sort of blew out. It went from 120 to 180 days. But if those buyers and those suppliers were given an opportunity to continue trading, in most cases, those SMEs were able to survive. Those
Mm.
buyers were able to make good on those payments.
Mm.
So in our experience, globally, looking across a diversified pool of invoice discounting collateral, and sort of shorter dated working capital loans, the default rates sit at around 1 to 1.5% per annum of the capital that you've deployed to those small businesses. Um, Again, that's looking at a single portfolio. You then take it at our level, where we've diversified across multiple portfolios. We're currently funding 50 independent companies within the portfolio. Um, and the average invoice size is sitting at around $4,700. You have a product that's inherently less risky than what I think people perceive it to be, and a huge amount of diversification,
Hmm.
which helps us to achieve a very consistent return year on year.
Hmm. That is a fantastic business. And off the back of that business, of course, you are all providing a very necessary lifeline, if you will, for a lot of people who can't access capital, which otherwise. which gets us, Sam, to the story of impact that you all are having. And maybe you could just start us down that path and tell us, what is it that you're seeking to deliver outside of financial returns? What do your investors expect to see? What is the impact that you all are hoping to produce in the world and to your borrowers?
Right. Yeah, thanks. So just to pick up on what Hendrik was talking about, our theory of change is really that small businesses are the engine of economic growth, that you can provide financing that's tailored to their needs, helps them create good jobs, and fuels inclusive, productive economic growth at the local level. So that's sort of what we were trying to achieve through our investment strategy. We have four goals: financial inclusion, getting money to the small businesses. Then we also wanted to make sure it's doing its job. So the money that gets to the small businesses, is it helping them create jobs? Is it helping them grow their revenue? The third thing that we're measuring is looking at the overall local economic system. Is the effect of our funding having a net positive impact? So developing these long-term partnerships with local financial institutions who have the small businesses as their long-term clients. And fourth, a core interest from us is so gender lens investing. So are we creating more opportunities for women? And we have a pretty robust impact metric matrix. We have been measuring this for 10 years, and we've run surveys for 8. And we collect information not only from the FI level, but also from the small business level to measure things like the size. Since inception, our fund has put $8.5 billion into circulation with the SMEs we finance. And we've done that across 68 countries. The direct impact of the people that we've affected is $16.8 million. So each of the SMEs we fund on average employs 50 people. So you multiply that by 4.9 people per household, and you come up with having an impact of almost 17 million people. And as Hendrik said, the average transaction size is under $5,000. So we're really meeting our target of being able to deliver a product that's tailored to the needs of small businesses, that has a profound and scalable, deep and broad impact globally. Some of the other stats that we're particularly proud of is how are the SMEs, once they get our funding, what happens? So we have, how are they surviving? How are they creating jobs? What's the revenue growth? So since inception, our funding has supported 3.4 million jobs, and we've created 448,000. Our financial institution partners have grown their revenue 64%, and 74% of the SMEs we fund have increased it by 10% or more. In terms of the stronger local financial ecosystems, 100% of our partners were compliant with the client protection principles last year. So that includes things looking at affordability for clients. So really going into a deep level to make sure they're not only making money, but they're doing it in an appropriate, ethical way that feeds long-term positive net impact. In terms of opportunities for women, so our fund is 100% women owned, and our 47% of our FI partners and 44% of the small businesses we fund are led by women, which compares to, in the US, they say that about 70% of the check writers for venture capital in the United States are women, and globally about 30% of businesses are led by women. So our results there on gender, we're quite proud of. But I'd like to turn it over to my colleague Sydney, who is the champion of our survey project. So again, we survey not only our financial institution partners, but once a year we really become the marketing partner to our partners. They have increasingly relied on us to not only collect the impact data we seek, but also to help them hear from their clients what's working, what's not working. So,
Sam, thanks. It's very clear that you guys take the collection of data seriously. And of course, that supports the effort that you guys are doing. I know Sydney is instrumental in all of that work. So, Sydney, perhaps you could help us understand exactly what it is that you guys are doing and how does that translate into the data and ultimately the metrics that you use to evaluate your success.
So just to add a bit more detail around the data collection process for us in our impact, it's a very integral part, um, collecting the surveys and everything. And so the whole process is conducted over several months out of the year, typically between the start of January all the way through to when we launch in June, so very soon. And the way that works is we start off by examining which of our FI partners in our portfolio that will participate in our survey. And then from there, we're able to administer a structured survey to them as well as to their clients. And so the surveys are designed to capture both qualitative and quantitative data, um, on details such as financial performance, business growth, or social outcomes, for example. And so this year we've had 20 countries participating in the survey, and 10 languages as well that we've worked to translate so that everyone who's involved with AGC can participate in the impact we're trying to reach. And so through aligning the surveys with an instrument like SurveyMonkey, we can use this to kind of collect the responses and ensure that the data we do receive helps us track the progress we're trying to work towards and the objective we're trying to reach.
Yeah.
So, Hendrik, you were going to say
Yeah,
something?
no, Rob. I just wanted to say, I think something that the public at large and LPs don't always appreciate is you pick up an impact report, and it might only be a dozen or a dozen and a half of pages, but the amount of effort and the amount of work that needs to go into pulling that information together, compiling that report, sort of analyzing that data, understanding what the numbers are telling you, across multiple different languages, multiple different jurisdictions, is a very heavy lift. And Sydney works with our investments team. It's a process that we've developed over the last 7 years. It's never quite perfect, but I think it's more perfect this year than what it was last. And yeah, I can't emphasize enough how instrumental Sydney is just to that process of sort of that heavy lift of getting that data, assisting Sam with analyzing of that information, and then ultimately compiling the report which we present to our investors.
Yeah, just to add to that, I don't know if it's redundant, but we really try to make this as useful as possible, not just to our investors, but also our partners. So these surveys, which Sydney is really instrumental in executing, allow the partners to have a conversation with us. They can add questions, they can modify this so that it meets their needs as much as possible. And it takes 10 minutes or less to answer it. So we sort of try to apply this kind of golden rule. A lot of us have worked and lived in small businesses in emerging markets. We're very conscientious of the value of the end beneficiary's time and for the process to be, sort of value add across the chain and not just be an extractive exercise for, impact investors to feel good about their investments. So I think our partners in Sydney, they wait every year for this survey to come out. We've actually become something they depend on in order to collect customer feedback. And
That's a fantastic framework for thinking about partnership, where everybody wins on multiple levels. Um, how do you guys think about, maybe this isn't the right way to say it, but who deserves your capital? Who deserves your support? How do you think about upfront those people who you're going to lend to? Because it does sound like it's a lot more than just a credit event, right? It sounds like you're actually very thoughtful about the constituents in your portfolio.
Yeah, Rob, if I can answer that question, I think first and foremost, we want to preserve the capital that investors have placed with us.
Mm-hmm.
You can have no impact anywhere in the world if you don't have capital to have that impact with. We are not philanthropic. We are a for-profit organization. We are trying to generate a fair rate of return for our investors, but while using their money to do good in the world. So the point I'm making is we always look at opportunities, funding opportunities, first and foremost through a credit lens. Uh, Impact is embedded in our entire investment process from start to finish. It's a consideration. We don't have we have a separate investments team and we have a separate impact team, but when it comes to impact analysis, it's integrated within our investments process. So we are considering impact from the very beginning, but we will never forego or sort of not consider credit risk, even if we can have a very big impact in a particular society or a particular value chain.
Mhm.
The way that we are thinking about impact is we want to find businesses that, as I said, first and foremost, are good credit risk, and where we feel we're being compensated for the risk that we are taking through the return that we're able to make. But then we've got very clearly defined impact goals. Women-owned businesses, women-managed businesses, underserved communities. If it's a particular value chain or ecosystem that's critical to, I'm thinking about, for example, coffee in Uganda. That's a value chain that a lot of people are employed in. It's a value chain that's very important to the local communities, and if we can support that chain, strengthen it, and just help families that are involved in those value chains. Again, it goes back to that economic prosperity that we were talking about.
It's beautiful. It really is. Um, I don't think people appreciate just how significant the role of capital is in an entrepreneur's life and in a family and a community's life. Because here in the developed world, we take it all for granted. Many of us, not all of us, of course, but many of us, we just go to a bank when we need a loan, and after filling out way too many forms.
Yeah, and I mean it's an interesting point that you raise. It's no secret what's happened over the last few months with organizations like USAID being disbanded.
Yeah.
Um, it's not had a direct impact on us as a fund or on our portfolio, but we have seen the impact on the ground. Not only in terms of financial inclusion, but in terms of healthcare, in terms of various other programs that were very reliant on this type of philanthropic capital. So we are doing our part to fulfill some of that need, but we obviously can't fulfill all of it. On the other end of the spectrum, you mentioned the banks. The banks are also a player. Uh, I don't think it's a phenomena that is only being seen in emerging markets. I mean, just this week, I was reading about a very prominent London-based bank that's withdrawing their business banking in the US. And that's going to leave 4,700 small businesses in the US having to go find a new banking home or a new relationship for all of their banking needs. And this is experienced in an exponential way when you go to developing countries. The banks don't see this as profitable business. They feel it's too bureaucratic. They feel the cost of capital that they need to hold is simply too high. And there are great businesses, domestic businesses, that are so important to their local communities that just aren't able to attract funding.
Hendrik, thank you. That is a really insightful set of comments on the way you guys think about your business. If I can, I'd like to pivot right now and think about the business of your business. And in particular, I always like to understand, what is it that makes the team there so special? What is it that makes you guys exceptional? And I do think it's fair to say you stand out from the crowd. And I'm going to pull rank here and ask the least tenured person on the team, Sydney, to maybe kick us off and give us your thoughts there.
Absolutely. Um, this may be, I guess, perhaps a kind of a soft answer, but as someone who's been on the team for a couple of years now, I think it's the integrity and the character of everyone that we work with that is just something I leave the office remembering every time the day ends, or we convene for an offsite every year, and half of us are based in London and the other half in Cape Town. And when we all come together, I think it serves as such a nice reset for everyone to kind of be together, laugh and joke and work and everything. And we kind of get to know each other on a deeper level. And at the end of the day, you realize you really have some solid characters working here at AGC. Um, and then another side of that is I think it's a genuinely diverse organization as well. Everyone except for me, I think, and one other colleague speaks a second or third or fourth language. And so we just have some incredible backgrounds and experiences. at the organization. And I think another thing that makes AGC click is Philip Sauer. he's he's probably the most efficient colleague of ours that you could ever have. To be honest,
Don't mention his nationality. It might be a racial slur.
he's very efficient. I'll just say that.
That's fantastic.
Rob, if you don't mind me just contributing or adding to what Sydney was saying, I'm glad that she's given the softer answer, because we obviously also look at things through a portfolio management lens. We've got a team, a senior management team that have been together for about 40 years collectively at AGC. Our chief risk officer.
40? 40?
40.
I've been there 11. He's been there 11, and the other two.
Correct. Yeah. It's a scary statistic that I try not to remind myself of it.
Yeah.
But it's 40. I've been with the firm for coming up 11 years. Our chief risk officer has been with the firm coming up 10 years. Chief operating officer has been with the firm for about 7 or 8 years. Sam's been there for 11. And I think what really helps is having that experience in this industry and just the knowledge that we've built up through time. We've got a very diverse staff base. As Sydney said, we sort of cover multiple languages, and collectively, I think we've worked in about 100 countries, or we've done transactions in about 100 countries. So again, just that experience and that diversity and experience, I think, contributes towards having very robust credit discussions and impact discussions, and funding companies that sort of meet that intersection between risk, return, and impact.
If I can just add a little bit more from the impact lens. So I agree with everything that both of them said. And I think the individuals, especially the senior people, all have done incredible things in commercial and finance for-profit industries. But I think it's fair to say nobody in this company is working here to get rich immediately in the short term. It's the purpose that I think binds us all together, as Sydney referenced, people that live in different countries, in Cape Town, hailing from New Mexico in Sydney's case, or South Africa, but it's a shared purpose and mutual respect for the in-depth knowledge that each player on the team brings to the table. So it's a very, I think, an organization where there's a high degree of trust, accountability, and that we can have hard discussions with one another to always try to get better and improve things as they go forward.
What a great way to think about going to work every day. Really. Can I pick up on something Hendrik just said, which was, the dual purpose of both having impact and having financial returns. Not everyone agrees that you can have both, right? There is this, in my opinion, false narrative around, return give up or concessionary returns, however you want to frame it. How do you guys think about the synergies between return and impact? How do you think about managing both at the same time? And frankly, what are the returns that your LPs expect?
Yeah. So I'll start with your last question first. And we aim to achieve a 300 basis point return over a risk-free rate. And a risk-free rate for us is defined as a 2-year treasury. So that's really where we position ourselves. When we set the fund up, when we launched the fund, the intention was never to provide concessionary capital. We wanted to provide capital on a market-related basis, and we wanted to generate a return, a risk-adjusted return for our LPs that we felt was commensurate with the risk that we were taking, while obviously demonstrating the impact through all of the processes and the surveys and everything that Sydney has spoken about. I think the impact investing world has shifted. I was looking at a statistic that Gin released recently where they've gone through a survey process, and the respondents have to select an option of whether or not they believe that impact investing should align with sort of concessionary capital. Should you be satisfied with a lower rate of return simply because it's an impact product? And two years ago, 67%, don't quote me on this, but it was around 66 or 67% of respondents said no. They said that even though you're making an impact investment, it should still generate a rate of return that's commensurate with other financial products that they could invest in. If you fast forward 12 months, it's now 78% of respondents have said that it
Yeah,
needs to be a commercially sort of comparable rate of return. So I think the collective mindset of impact investors is shifting. I think there's still a need for catalytic capital. I think there's still a very, very big need for investors that have got pools of money to provide first loss tranches into multi-tranche funds, or into other structures. And you have foundations, you have players in the space. You've got people like Kenyath, for example, I think is doing amazing work in that space. But really where we try to position ourselves is by being an impact-minded, impact-first asset manager while generating a rate of return that's commensurate with the risk that we're sort of taking on the portfolio.
fantastic. I mean, that is, to my mind, as an investor, that is the framework that everyone should be using for thinking about the the dual intentions of generating impact and generating return. I'm always frustrated, even by the phrase concessionary capital, because let's say I have made the conscious decision to allocate capital to a strategy for a specific return, and I consciously accept whatever rate of return the GP is trying to deliver. There's nothing concessionary about that. I'm not conceding anything, right? I've made that intentional decision, as many people do, as you just said, Hendrik, when they're making allocations of capital into catalytic purposes, right? You're trying to catalyze something. That's not a concession. That's a conscious decision.
No,
And
exactly.
then,
Yeah. When people ask me that question, something that I typically answer is when they ask about our returns, rather than answering in adjectives, we provide numbers. So what were our returns?
yeah,
And with a 10-year track record,
hmm,
then that sort of gets at that question. And some flippant thing that I use sometimes is we don't do concessionary investing, and our returns are not concessionary, but we never do concessionary impact. So we keep the bar high in terms of what we're aiming to achieve to meet our investors' expectations of what we said we're
that's,
going to do.
I'm going to steal that, Sam. That's a great
Yeah,
phrase. I like
right. I
that.
like it. I've been
I like
waiting
that.
for years to use it somewhere.
Excellent. I'm glad I can help. So,
Yeah, I mean,
so we're,
Rob,
go
I
ahead.
don't want to, I don't sort of want to segue the conversation in a certain direction, but tied to this point is there are certain financial players there that I think should be actively fulfilling that catalytic, tranche in a fund, or that catalytic piece within a securitization structure. And I'm, particularly taking aim at some of the government's institutions that exist around the world. And I think that's been a big frustration for us over the last probably 12 to 24 months, where a lot of the conversations we've had with them, have led to a development financial institution expecting private capital to come in, as first loss money against their facility, or as first loss money protecting them in a fund. And that sort of whole reason why they exist just seems to have been flipped on its head, which has been it's been a frustrating experience,
Yeah, I'm
sort of over
sure.
the last 2 years.
Yeah, it really ought to be the other way.
And maybe if I could just add a thought on this topic, which is, I think one thing that we've applied throughout the years is also a dedication to transparency.
Yeah.
So we try to do our best to tell people what we're doing. So we lend to our local financial institutions, and we charge as high a rate as we can, but we also need to make sure they remain sustainable. And we also check the rates that they're charging their SME clients. So it's our strategy and our model has enough returns in it for investors, for partners, and for SMEs, and it's carefully checked. And we just tell people what it is. And in our industry, the one area of that is getting that we look at very carefully are the end rates charged to small and medium-sized businesses. As Hendrik alluded, if you're talking about consumer lending, and the world gets really blurry when you're talking about informal sole proprietors in emerging markets and consumers, that line can be quite blurry. But we do look a lot at those rates to ensure that we're
Hmm.
not trying to deliver outsized rates to investors who may lack the transparency and ability to know what that really means. So as part of
Hmm.
that, last year we implement. We had all of our partners go through an exercise. We're looking at client protection principles and the rates that they are charging to their clients to ensure that they are small business rates, which they are. And that translates into the type of returns that Hendrik was explaining. And we're just open about it. If somebody needs 20% return for their portfolio, then you shouldn't invest in our fund. But
Mm-hmm.
if we tell you what we're expecting and our 10-year track record
Mm-hmm.
allows us to demonstrate that we have been able to return what we said we're going to, and you can decide, informed decision making for our investors.
Sure. And you know, I've always thought as an investor that if something looks too good to be true, if return commitments are too high, they probably aren't durable. You know, either because there'll be some arbitrage opportunity that just takes it away, or because there's something that I don't quite understand about whatever it is that's going on that doesn't add up. And ultimately, that's what you guys are doing, right?
Yeah.
Making sure that the return profile represents a durable business over time. Makes a lot of sense.
And our targeting small businesses also, I think, reduces the impact risk. So when you're funding a small business, they have employees, the employees are consumers. But when you funnel it to a business that's generating a profit and they understand the rates that they're being charged, you know you're not taking advantage of somebody who doesn't understand what they're getting into. And also you're fueling it at a higher position in the value chain. And you're getting all the consumption benefits later, but at sort of where the risk return and the impact are kind of easier and clearer to understand.
Amen. So, so I want to stick with the theme of transparency, but also pivot a bit, because one of the things that struck us at the Impact Evaluation Lab as we were going through the process of evaluating you was the ease with which you provided information and the consistency of the integrity of the information. And I think that immediately struck us as a signal of strength. But I'm really curious to know how you thought about the process of working with us and how that may have even helped strengthen or helped inform you in ways that were beneficial to what you're trying to achieve.
Sydney?
Yes, of course. um, so I would describe the process of working with IEL. It's really insightful for us, but also very straightforward and simple as well. I really feel like each of you had been very collaborative and accommodating through every step of the process, because I think there was a point where we wanted to review and rework some of the responses that we had sent through for the assessment, and had found everyone to be quite supportive in working with us in order to do that, because that will have involved us speaking to our team internally just to make sure everything aligns before we did submit something final for you guys to assess.
Mhm.
um, and so for that we were very appreciative of.
Well, that is
Yeah,
that's wholly intentional, Sydney. So I appreciate you saying that. You know, that the idea that we can get everything right about you by reading a document to us is just not really a valid assumption. You
Mm.
know, we want to understand what your process is and as closely as possible mimic an institutional due diligence process that's familiar to folks like you, right? Where you're answering questions that are being asked in the context of an intentional investment, not just for the sake of, you know, checking a box.
yeah. I think if we think about the accounting standards and how they've evolved through time, there really are two frameworks that exist today. There's the US framework and there's the international framework, and most people would align themselves with one of those frameworks. And it's very easy to compare two different companies, even in two different countries or two different continents, against the framework that exists and the assurances that you would get from external parties like auditors, for example. And I think the challenge when it comes to impact measurement and reporting is that there's so many sort of different frameworks that exist
Mm-hmm.
today. Simply looking at the frameworks that have emerged in Europe versus the frameworks that have emerged in the US, I don't think there's consistent reporting. I don't think that there's consistency in the way that fund managers or asset managers or anyone in the space really is being assessed. And I think that that's really what we value, is the ability to take two different asset managers that might not even be within the same asset class or the same sector, and look at a number which gives you a really good read on how true they are to what they say they're doing. They've gone through that external verification process with the Impact Evaluations Lab, and it's very easy to interpret the number that you're seeing on the tin.
Well, I appreciate you saying that, Hendrik, very much, because that is one of our intentions and one of the reasons we built the firm. It also speaks to the process by which we created our evaluation framework, which is we reached out to everybody we knew in the impact space, and like you all, I've been in it for quite some time, and made sure that whatever we landed on was consistent with the expectations of the impact community. Doesn't mean we agree with everybody, but I do think everyone would say they understand why we made certain decisions about the methodology. Nothing's off the ranch, so to speak.
Yeah. No, I think it is great.
Thank you. Really appreciate you saying that.
Something that I really appreciated about your approach also was the way you tried to level the playing field, but have it remain accessible to the new innovative firms, and not only the ones that are large enough to pay for the fanciest impact report writers, or a lot of people are outsourcing many of these activities, which is great. Some of them do wonderful work, but it's maybe not something that's accessible to all, especially those that are joining. So that I really appreciated that. And also, I think in early days, you might have had some of the early adopters who understood the impact that they wanted to see more in depth, and you maybe needed third-party verification less than you might if you want to expand the market, which we all want to do. And you need a third party who understands it in depth, that you can trust to provide some clarity and a stamp of approval, a second opinion, if you will. So we're happy to participate in the process and get some free consulting along the way. We've been through many of them, PRI, UNSDGs, 2X Global, and you learn something from all of them. But the integrity that you guys have set forth, your framework, it really resonates with us in terms of striking the right balance, trying to do the right thing, but do it in a really rigorous manner.
Well, thank you, Sam. That's really appreciated. That's good to hear. Thank you. I do want to say that, as we thought about the smaller investment firms that we're trying to work with, we do believe that the highest impact that we can have is on helping those funds get launched, right? And helping those funds by authenticating the work that they're doing. No offense to anybody, but the firms with $10 billion that are spun out of, some other $50 billion private equity fund don't really need the evaluative work that we do. At least that's what they think. We could have a long discussion about that, but we are trying to help facilitate the allocation of capital into strategies that are doing something really good for the world, and oftentimes those are younger and less well-established firms. So, guys, thank you. This has been a real pleasure working with you again. I'm thankful for your willingness to take some more time with us. I do want to wrap things up by engaging in a little bit of fun. So if I could first ask each of you the following question. What is the favorite food that you like to eat out that you would never cook at home?
Probably sushi for me.
For me, bún at a Vietnamese restaurant. So it's cold noodles, vegetables, and grilled shrimp.
And for me, steak and fries.
Nice.
I don't think I'm really good at cooking a steak, so I'd rather have it at a restaurant.
That's fantastic. And what's the food that you would cook at home?
My wife jokes with me that I should have been born in Italy. I'm quite happy to eat sort of pizza or pasta 7 nights of the week. She's not as big a fan, but for me, that's my go-to.
Nothing beats a good barbecue, chicken, and good potatoes and some corn.
Excellent. Sydney, how about you?
For me, I'm on an omelet kick. I've been making omelets
Oh, okay.
quite a lot. You can put all kinds of things on eggs and cook it. So that's for me.
Nice. Nice. Last question. Favorite musician?
I'm really enjoying Xavier Rudd at the moment.
Mm.
Sort of Australian folky type music.
Hmm.
Reminds me, of someone that we used to listen to back in South Africa back in the day. Yeah, just sort of everything that he's doing is great.
That was my absolute favorite, but I've been kind of drifting back to my college days. Tracy Chapman. I just feel like her
Yes.
words and the tunes they're really
Yes.
hitting me right now.
For me, well, I just saw Beyonce, so I have to say that one.
Fantastic. Well, thank you. I appreciate it. Thanks for the fun.
Thank you.
Thank you.
All right.